Let me ask you something real quick. What if I told you that most investors don't lose money because they pick bad stocks, they lose money because they don't stay invested long enough? Because here's the truth no one likes to admit. Time in the market matters more than picking winners. More than market timing. More than hot stocks. More than guessing the next big thing. In fact, long-term investing, compound interest, and investor behavior matter far more than finding the perfect stock. And most people don't realize this until years, sometimes decades, later, when the damage is already done. In this video, I'm going to show you why time in the market beats picking winners, how emotional investing quietly destroys returns, and how a simple investing strategy can outperform most active investors, without stress, guessing, or burnout. Before we dive in, make sure you subscribe to Life Plus Money. This channel is all about wealth building, stock market investing, and long-term financial freedom using calm, practical strategies that actually work in real life, not hype. Now let's break this down in a way that finally makes sense. Because once you truly understand time in the market versus picking winners, you'll never look at investing the same way again. And by the end of this video, you'll know exactly why most investors lose money, even when they're technically right. The biggest investing myth, one of the most dangerous myths in investing, is the belief that success comes from finding the perfect stock. People are taught, directly or indirectly, that wealth is built by picking winners, timing tops and bottoms, and jumping in and out of the market at just the right moment. It sounds logical. It feels smart. And it's incredibly seductive. But historically, that mindset has done more damage to portfolios than almost anything else. Because market timing versus time in the market isn't a fair fight. And market timing almost always loses. Why? Because the stock market doesn't reward clever predictions. It rewards discipline and consistency. This is where buy and hold investing quietly outperforms flashy strategies. The most successful investors aren't the smartest people in the room. They're the ones who stay invested when it feels uncomfortable. Why time in the market actually wins? When you zoom out and look at decades of historical stock market returns, something interesting becomes very clear. The biggest gains in the market don't happen slowly and evenly. They happen in bursts. Often, after major sell-offs during periods of fear, when headlines are at their worst, miss just a handful of the best market days, and your long-term returns can drop dramatically. That's why research around missed best market days is so eye-opening. You might be right about the long-term direction of the market. But if you're wrong about when to be invested, even slightly, your results suffer. And being out of the market during recovery days absolutely crushes compounding returns. This is exactly why time in the market beats picking winners again and again. Compound interest does the heavy lifting. Compound interest is one of the most misunderstood forces in investing. Early on, it doesn't feel powerful. It feels slow. Almost underwhelming. That's why many people abandon their plan too soon. But over time, compounding turns patience into momentum. This is why long-term investing works so well. Small gains stack. Returns build on returns. Time begins doing the work for you. This is also why passive investing, index fund investing, and ETF investing are so effective for real people with real lives. They reduce decision-making. They minimize emotional investing. They keep you invested through market volatility. And staying invested is the single most important variable. Why most investors lose money? Here's the uncomfortable truth. Most investors don't fail because of bad math. They fail because of behavior. Fear. Greed. Impatience. This is what emotional investing looks like in real life. Selling when markets fall because it feels safer. chasing hot stocks after they've already gone up, abandoning a long-term plan during temporary downturns. Ironically, this behavior shows up most during the moments when staying invested matters the most. That's why investing psychology is just as important as understanding charts, ratios, or numbers. The market punishes emotional decisions and rewards calm, boring ones. Quick reminder: if this is helping you think more clearly about money and investing, make sure you subscribe to Life Plus Money. Every week, we break down financial discipline, risk management, and real-world investing strategies you can actually stick with. Pause for a second. If investing feels stressful, confusing, or exhausting, that's not a personal failure. That's what happens when you're taught to believe you need to constantly do something to succeed. Most people don't need better stock picks. They need fewer decisions. Because investing works best when it becomes boring. If you've ever felt like you were behind, late, or doing it wrong, you're not. You've just been told the wrong story. Now let's keep going. What the data actually shows. Let's talk about the S&P 500 long-term returns. Over decades, the market has trended upward, despite recessions, crashes, wars, inflation scares, and endless negative headlines. Investors who stayed invested through those periods consistently outperformed those who tried to jump in and out. This is where diversification matters. Owning broad market exposure through index funds or ETFs spreads risk and smooths volatility over time. You don't need to predict the future. You don't need perfect timing. You just need to stay invested. A simple investing strategy that works. Here's what works for most people, not on paper, but in real life. Dollar cost averaging. Broad market exposure. Long-term holding. Minimal tinkering. This approach lowers stress and supports financial independence and retirement investing over time. It's not exciting, but it's effective. And most importantly, it's repeatable. Which is exactly why it works. Time beats talent. Some investors will pick winners. But even professionals struggle to do it consistently. What matters more than talent is staying invested, managing risk, and avoiding common investing mistakes. Because why timing the market fails isn't about intelligence. It's about probability. And probability favors patience. The real takeaway: if you remember one thing from this video, let it be this: wealth is built by time, not timing. You don't need to outsmart the market. You don't need to predict the next big winner. You need to stay in the market long enough for compounding to do its job. Because time in the market matters more than picking winners, every single time. If you want more videos like this, simple, calm, real-world guidance on stock market investing, wealth building, and long-term financial success, make sure you subscribe to Life Plus Money. If this helped you rethink how investing actually works, hit the like button and share it with someone who needs to hear it. I'll see you in the next one.